Shane Oliver is joining me now, Head of Investment Strategy and Chief Economist at AMP Capital Investors, with in fact they have about $100 billion under management. All that money to advise your clients on, Shane. And again, a Santa rally depends on one certain bank, and it's not an Australian bank.
That's right. I think everything here is sitting on the ECB. A couple of weeks ago, or a week and a half ago, the European Central Bank, the president there said if we had a fiscal compact in Europe, then other things might follow. That was interpreted as indicating the European Central Bank might get more involved in helping out European countries. Then, of course, all that was reversed last week. So we got the fiscal compact, but of course we haven't seen the follow-through from the European Central Bank, with Mario Draghi implying that no such thing was ever implied. So I think at the end of the day, the fiscal compact is great. It might help over the long term, might help prevent the next crisis. Not going to help in the short term, though. And of course the extra money for the IMF, a lot of question marks about that, and the bring forward of the European Stability Mechanism. So unfortunately, Europe has moved in the right direction, but yet again they've really disappointed here. We really need to see follow-through on the part of the European Central Bank.
Shane, I have to ask, with all your colleagues, whether it's at the bank, AMP, or also, of course, right across the region in Australia and, of course, also around the world, when you see an EU meeting, there's been about 9 now, about 21 months, whatever it is, do you just think, here we go again, nothing will come out of it, waste of time?
Basically, that's true. The unfortunate thing is those EU meetings often go all night or all through the day, and then cut into weekends, as the last one did. So we're going through a waste of time, and it also cuts into the weekends. So it is quite annoying, particularly when you're down in Australia, where weekends are particularly valued. But yet again, I think the Europeans have failed to deliver. It's a move in the right direction, but they're not doing enough, not doing it quickly enough. And I think until we see the European Central Bank step up to the plate and act as lender of last resort, not via the back door, via the banks, but directly in terms of buying bond markets in these troubled countries, then it's hard to see an end to this crisis.
Okay, Mario Draghi has been in his term quite short term. Many economists have called Ben Bernanke as the central banker of choice for this year. He gets the award for that. I don't know if you agree on that. But the Fed, of course, meets today, if like later in the US. What do you expect from the Fed? What can they do? What should they do? And is Ben Bernanke your central banker of the year?
He certainly would be, although our own central banker in Australia, I think, would follow a close second, or just behind Bernanke, in that Glenn Stevens of the Reserve Bank has admitted that they tightened too much and have since changed direction and starting to cut rates. But I think what Bernanke has done is looked at the 1930s, realised that there is a real deflationary threat in the US, and therefore he's continued to do whatever is necessary to keep the US economy recovering. Did look a bit shaky around the middle of the year, but of course it's come through since then. So I think, and that of course is also helping the US bond market, because you've got this constant threat that the US government, the US central bank rather, the Fed, will buy up bonds. So that's of course helping stop speculators from selling US government bonds. But I think in terms of the meeting this week, I don't see a big change from the Fed. I don't think we'll see anything new in terms of actual monetary policy. What we may see, though, is a bit more in terms of the communications. We may see, if not this month, then at the meeting in January, the Fed actually outline how it sees the Fed funds rate going forward. And I think if they do that, they'll probably tell us that the outlook for the Fed funds rate they see is below what the market currently expects. And if that's the case, then it would actually help pull down the whole yield curve in the US and provide a bit of stimulus in that sense. But I don't see any concrete change. I don't see QE3, and of course there's not much they can do on interest rates generally in terms of changing the level.
Shane, quick question for you. Seconds are against us. Australian dollar, being a patriot Australian as you are, like you said, like all risky assets, remains vulnerable in the short term. How vulnerable is it?
Well, it is seen as a growth asset. The reality is that 70% of Australian exports are commodity related, and whenever there's concerns about global growth, that weighs on commodity prices, hence weighs on the Australian dollar. So it wouldn't at all surprise me to see us pushed down back into the 90s. You know, a couple of weeks back we went down to 95. almost got as low as 94 a couple of months ago. So it wouldn't surprise them if we get back to those sorts of levels in the short term. Longer term, I think the Australian dollar will remain strong because we're going to see more quantitative easing in the US probably next year. Ultimately in Europe, I think they'll have to capitulate on that one. That's negative for their currencies, positive for the Australian dollar, and I think growth going forward over the years ahead will come out of the emerging world. That'll be commodity intensive growth and very positive for the Australian dollar. But short term there is that risk. We could head down into the levels just between 90 and 95 cents against the US dollar.
Shane, Doctor of Economics, in fact, and also, of course, Chief Economist at AMP Investors. Many thanks indeed for joining us.